In this video, we're going to take a look at what the textbook calls the exchange of non-monetary assets. And those are ordinarily accounted for on the basis of the fair value of the asset given up or the fair value of the asset received, whichever is more clearly evident. But I've got a bone to pick with the exchange of non-monetary assets. We could just as easily say that we are talking about the exchanges of both monetary and non-monetary exchanges. What we're going to find is that it doesn't matter whether we're talking about monetary or non-monetary exchanges. We can apply the same set of rules. Let's go ahead and take a look at some examples and we'll see what we're talking about. Let's consider the exchange of a blue 2008 delivery van that originally cost $20,000 and has $14,000 in accumulated depreciation for $8,000 in cash. What do? Well, first thing we would do is we're going to take the original cost of the van off our books. So we'll credit the old van for $20,000. We need to take the accumulated depreciation off the books for $14,000. We received $8,000 in cash. And we can very quickly see that debits don't equal credits. We've got $22,000 in debits and $20,000 for credits. And we received $8,000 for something that had a net book value of $6,000. So we've got a gain of $2,000. That's all fairly straightforward. But one thing I want to notice, I use the word exchange. We exchanged a blue van for cash. We would often also say that we sold the blue van for cash, but we could, instead of using the word sold, we could say exchanged. And in this case, we had a gain. If, on the other hand, we had only received, let's say, the same van, taking it off our books, but we'd only received $4,000 in cash, we can quickly see that we had a net book value of $6,000. We received $4,000, so we had a loss of $2,000. And again, we're talking about a sale, or just as easily we can say an exchange of an asset for cash. Let's consider another case. In this case, we've exchanged our blue delivery van, same van, but instead of exchanging it for $8,000 in cash, we've chosen to instead exchange it for $8,000 in marketable securities. Or we could say we sold it for $8,000 in marketable securities. Once again, we need to take the old van off our books along with the accumulated depreciation. Now, instead of debiting cash for $8,000, we will debit marketable securities for $8,000. And once again, of course, we have the same $2,000 gain. Let's now consider another exchange. Same van, same net book value, but this time we exchange it for $8,000 worth of inventory. We need to take the old van off our books. We need to take the accumulated depreciation off our books. We need to record the inventory. And again, we have a $2,000 gain. So it didn't matter whether we exchanged our van for cash, we exchanged it for marketable securities, or we exchanged it for inventory. In all three cases, we recorded a $2,000 gain because we received $8,000 in fair value for something that had a book value or net book value of $6,000. Now let's exchange our blue delivery van, same van, for an $8,000 red 2008 delivery van. So the exact same van, except ours was blue, and we're trading it for a red van. Again, the first step, take the old van off the book, take its cost off the books, take its accumulated depreciation off the books. Now, if we followed our old pattern, we would record the new van at a book value of $8,000. But we would say that this transaction lacks commercial substance. In other words, our position really hasn't been changed. When we traded our van for cash, cash is very different than a van. We traded our van for marketable securities, very different than a van. Inventory is very different than a van. But is a red 2008 delivery van that much different than a blue 2008 delivery van? And the answer is no. We would say this transaction lacks what we call commercial substance. What do we mean by commercial substance? We say an exchange has commercial substance if the future cash flows change as a result of the transaction. That is, if the two parties' economic position changes. we would say the transaction has commercial substance. Let's go back to our examples. For our first exchange, where we traded our van for cash, we clearly have commercial substance because the timing and amount of our future cash flows have changed. Our blue delivery van is going to generate cash flows over some foreseeable time in the future, versus now we've got, after the exchange, we've got $8,000 in cash today, but no more cash coming down the road. So clearly, the timing and extent of our future cash flows has changed. The same can be said for trading our delivery van for $8,000 in marketable securities. The timing of our future cash flows and the amount has clearly again changed. Trading our van for inventory, again, the amount and timing of our future cash flows will be different, so we would say the transaction has commercial substance. But trading a blue van for an identical red van, the timing and amounts of future cash flows won't change, so we would say this transaction lacks commercial substance. And if it lacks commercial substance, that means we will not record any gain whatsoever. But just because we're not recording a gain doesn't mean the rules of double entry bookkeeping don't have to hold. We still need to have debits equaling credits. What we're going to do then is we're going to record the new van at a reduced amount. We will record it at an amount equal to the net book value of our old van. We will record the new van at $6,000 and we will say we will defer the $2,000 gain to future periods. And we'll look at what that means in a few minutes. What if instead we traded our 2008 delivery van for an $8,000 miniature horse? Well, as always, we want to take the old van off our books. So we credit the $20,000 cost, we debit the accumulated depreciation. Our next step is we have to determine whether or not this transaction has commercial substance. And that will be dependent on the facts and circumstances of the case at hand. If we say the transaction lacks commercial substance, in other words, we're going to use the miniature horse to deliver the same packages that we did with our old delivery van, and it's going to generate the same cash flows, we would say there's no commercial substance, there's no difference between the mini horse and the van, and we record the mini horse at $6,000. On the other hand, if we said the transaction did have commercial substance, in other words, the future cash flows that we're going to derive from having a mini horse are very different than those that we would have had with our minivan, we would record the mini horse at its fair value of $8,000, and we would record our $2,000 gain. So again, if the timing and amount of future cash flows are different, we say the transaction has commercial substance. That is, the economic position of the company has changed, and we record the gain. So when we trade the van for cash, we record the gain. We trade the van for marketable securities, we record the gain. When we trade the van for inventory, we have commercial substance, we record the gain. However, if we trade the blue van for a red van, we say our economic position hasn't changed. In other words, our future cash flows haven't changed. We say this transaction lacks commercial substance, and we will not record the gain. We will what we call defer the gain, and we record the new van at the net book value of the old van. When we talk about deferring the gain, let's look and see what the impact on the income statement is going to be on both from the gain and depreciation expense under the two different scenarios, one where we recognize the gain and the other one where we deferred the gain. We're going to assume that our new van has a remaining life of 3 years. When we recognized the gain, we recorded the new van at a net book value of $8,000, and we did not record, or we recorded rather, a $2,000 gain at the time of the exchange. If our equipment has an $8,000 book value in a 3-year life, our depreciation expense in year 1 will be $8,000 divided by 3, or $2,667. The same for year 2, the same for year 3. So the cumulative impact on net income from our $2,000 gain and our $8,000 in depreciation expense will be $6,000 loss over this 3-year period, or we should say an expense. What if we defer the gain? If we defer the gain, that means we're going to record the book value of the new equipment is $6,000, which is equal to the book value of our old equipment, and we don't record a gain. Now notice our depreciation expense in each of the following 3 years will be less. It'll be $2,000 in year 1, $2,000 in year 2, and $2,000 in year 3. Over the 3-year period, whether we recognize the gain or defer the gain, the cumulative impact on net income will be a $6,000 decrease in both scenarios. But when we say the transaction has commercial substance, we will recognize the gain today and we will have higher depreciation expense in the future. If we say the transaction lacks commercial substance, if there's been no change in our economic position, well then we shouldn't record a gain and we should continue to record depreciation expense on our asset just as we would have recorded it on the old asset. So to summarize what we've done so far, our transaction can have commercial substance or lack commercial substance. The first thing we notice is whether it has or lacks commercial substance. We always recognize losses immediately. So whether we exchange our van for inventory, for cash, for an identical van, if the transaction results in a loss, we will record the loss immediately. However, if the transaction has commercial substance, we will recognize the gain immediately, but if it lacks commercial substance, in other words, there's been no significant change in the timing or amount of future cash flows as a result of the transaction, then we shouldn't report a gain, and we will record the new equipment at the net book value of the old equipment, and we will defer the gain. So again, no commercial substance, no gain. Now let's consider the situation where the exchange lacks commercial substance, but we receive a little bit of cash. Now obviously, if we receive a little bit of cash today, there's been some change in the timing of future cash flows, because if we held on to the delivery truck, we wouldn't have any cash today, but if as a result of the exchange we receive a little bit of cash, well then we say there is a little bit of commercial substance, and we will recognize a little bit of the gain. Now the one caveat here is if the amount of cash we receive is more than 25% of the total value that we receive, we say, screw it, there's been a big enough change in our future cash flows that we are going to deem the transaction to have commercial substance, and we will recognize the entire gain. Let's go ahead and take a look at some examples. Let's exchange equipment with a fair market value of $8,000 for nearly identical equipment. That's our key suggesting that this lacks commercial substance. With a fair value of $8,000. The equipment originally cost $20,000 and has $15,000 in accumulated depreciation. Step 1, take the old equipment off our books. Step 2, take the accumulated depreciation on the old equipment off our books. Again, because this is nearly identical equipment, we would say this lacks commercial substance. And if it lacks commercial substance, nothing's happened. We should not record a gain. Again, debits need to equal credits, and so we are going to record the new equipment at the difference. That's our plug for our journal entry, $5,000. And notice that $5,000 is the fair value of the new equipment minus the $3,000 deferred gain. Let's consider an exchange of equipment with a fair value of $8,000 for different equipment with a fair value of $7,000 and $1,000 in cash. The different equipment is our key that this has some commercial substance. And so let's go ahead and take a look at our transaction, assuming that it has commercial substance. As always, take off the old equipment, take off the accumulated depreciation, record the cash that we received. Now let's go ahead and calculate our gain. We received fair value of $8,000. That's $7,000 in equipment and $1,000 in cash. The net book value of our old equipment was $5,000, which means we have a $3,000 gain. And since there's commercial substance, we record the entire gain, and our new equipment will be recorded at its fair value of $7,000. Now let's look and see how this would change if instead of different equipment, it was nearly identical equipment with a fair value of $7,000 and $1,000 in cash. Although the equipment's nearly identical, we received some cash, so we would say we had some commercial substance. And let's go ahead and calculate how much of the gain we would recognize. Again, we take the old equipment off our books and we record the cash. And let's go ahead and calculate our gain once again. We received $8,000 in fair value. That's the $7,000 in equipment and the $1,000 in cash. Our net book value was $5,000, so we had a gain of $3,000. In terms of the amount of cash we received, of the $8,000 total fair value, $1,000 was cash. 1,000 divided by 8,000 equals 12.5%. So we will recognize 12.5% of the gain, or $375. So we record the $375 gain. Now we need to make sure our journal entries, balances, that is, debits, equal credits. And for this to be the case, we need to debit the new equipment for $4,375. This is the $7,000 fair value of the equipment we received minus the $2,625 deferred gain. So again, since our transaction had some commercial substance, despite the fact that we were trading one piece of equipment for nearly identical equipment, the fact that we got some cash says some commercial substance, and we will recognize some of the gain. So again, if the transaction lacks commercial substance, but we receive some cash, we will recognize a partial gain. If cash is 25% or more of the fair value of the exchange, we're going to assume that the entire transaction has commercial substance because the amount and timing of our cash flows has changed significantly. So let's look at an example where cash is 25% of the amount of the fair value we received. Now we give up our equipment that had a fair value of $8,000 for the nearly identical equipment with a fair value of $6,000 and $2,000 in cash. So nearly identical suggests there's no commercial substance, but the fact that we got cash says, wait a minute, there is some commercial substance. Let's go ahead and take the old equipment off our books. We credit old equipment for $20,000. We debit the accumulated depreciation. We need to record our $2,000 in cash. Now we need to figure out our gain. In terms of fair value we received $6,000 in equipment, $2,000 in cash for a total of $8,000. The net book value given up was $5,000. We have a $3,000 gain. $2,000 of the total $8,000 that we received was cash, so that's accounting for 25% of our fair value. And if cash is 25% or more of the fair value, we recognize the entire gain. We assume the earnings process is complete, that there is commercial substance. So we record the $3,000 gain, and then for debits to equal credits, we record our new equipment at its fair value of $6,000, and we do not defer any gain to future periods. And that is because we've deemed the transaction to have commercial substance, because cash was more than 25% of the total fair value that we received. So again, we always recognize losses whether the transaction has commercial substance or it doesn't. If the exchange has commercial substance, we will recognize the gain. If it lacks commercial substance, we defer the gain. If we receive some cash, a little bit of cash means a little bit of gain, and we will record partial gain. If the cash is more than 25% of the total fair value we receive, we will record all of the gain.